So this slideshow is created by Matson Money, and on that starting little video showed different clips of Mark Madsen on Fox Business News and other business programs. And so his Matson Money created this presentation. So what's my connection with Mark Madsen? My connection is that as an estate planning attorney, after I watched my poor clients get clobbered by the tech crash in 2002, and then saw them um, uh, have a very bad experience in the 2008 period, I decided that I needed to help my clients invest using the principles from the Nobel Prizes have been given on how to invest in the stock market, and it's not applied by most people and not understood by most people. Well, at any rate, so I wanted to help my clients use these techniques. And in order to have an investment business, you have to affiliate with one of these big outfits, Schwab or one of the big broker dealers. Well, none of them are interested in that. Plain and simple, not their part of their business model. And so I was getting pretty frustrated, and I in 2012, I by luck or providence ran into Mark Madsen, and his firm is since '92 has been committed exclusively to applying the the principles of investing. And so that's my connection with him. He's my co-advisor, and he creates the portfolios that we work with the clients to decide how it's going to be set up and what it's going to consist of, and then he provides the investments to accomplish that. So that's the relationship. At any rate, this morning what we're going to talk about is mind over money. And the blurbette down there says, discover the forces that work against you as an investor on Wall Street and Main Street, and what you can do to arm yourself against them. And let's see, as we're getting started, Mary, am I loud enough and everything?
You sound very good, and the pictures are very nice.
Good. Okay. So now, when we think about mind over money, all of us want to think of ourselves as being rational, right? And as a matter of fact, most of us pride ourselves on being rational. And we think in the important areas of our life, that we try to be rational. And yet, both Wall Street and our own heads work against us in doing this. So we need to explore this today so we can see how to arm ourselves against it. So what are our assertions as we start off with? The first is there are Wall Street bullies who can profit from destroying your American dream. So, people throw around this American dream thing all the time, but we're using it in an appropriate way, I think. Your American, your retirement, your future, your concept of what you're doing, the people you care about are your American dream. And the fuel for your American dream are your savings, your life savings. Okay. And so if we're not successful with the handling of our life savings, then that takes away from the things that we care about and the people that we care about. So this is right at the heart of what's important to people, and very important to people. Second assertion, it's critical to master the empirically tested academic investing research because your future and your dreams hang in the balance. So one of the things I always say, sadly, is that in my long experience, 25 years as an estate planning attorney, most of my estate planning clients got mediocre or terrible results with their life savings over the period of their retirement. And that's why I decided to go into this business of trying to assist people with this. And so what is our defense against it? Well, it's understanding our own mind, and it's also understanding that there are actually principles out there we can apply to have the best opportunity of success. And of course, we care about our families, we care about our children, we care about the charities and churches that we go to. So those are all fueled or connected to our life savings. And so is that worth fighting for? Well, of course. And so is this important to us? Well, of course. So how can we make sure we know how to do this and that we're not misled by what's going on? So the first assertion is that we want to expand on is that there are Wall Street bullies who can profit from destroying your American dream. So what's a bully? So it's a person who habitually seeks to harm or intimidate those who they perceive as vulnerable. So I don't know if you've been thinking about Wall Street as habitually seeking to harm or intimidate. You probably don't think of them as that malevolent. And yet you're going to see some stuff as we go through this. And as a verb, it means to seek to harm, intimidate, or coerce. So who are these bullies? And what do? Well, they play off of our fears and deepest desires. When we talk to anybody, if you are talking about the investing and handling of your life savings, this is something that we have high hopes for and we're worried about. And so Wall Street and investment advisors and the insurance companies all have this big string on our insides that they play on. So as we're thinking about this, what are your three biggest fears? So just think about that for a second. What are your if you what am I worried about? I don't know if somebody wants to pitch in, but maybe I'll help you a little bit, and you tell me if you think of something else. So some people might say, well, my concern is my health, or that something will happen to me, or I'm worried about my spouse's health, or maybe your children or grandchildren have some issue. And so, or we're just worried that in the future we're going to face health issues and that this is going to have a dramatically bad effect on our family. So that's certainly one of the biggest for people. Some people are, worried that that our culture and our country are going in the wrong direction, and we wonder how this is going to play out for not only our life savings, but for the people we care about. So I don't know if there's some other things that you think of right off the bat that you want to pitch in there, but I think they run along those lines. If we wanted to sum it all up, it's the sense that we might not make it, the fear of not being able to make it. Now, of course, in some level, the fact is we aren't going to make it, period. We all know that nobody gets out of this life alive. So we're really not going to make it. But that raises the question, or leaves us with this, that how can we make the best use of the time that we do have? So that's one dimension. And the other dimension is, what are your greatest investing desires? Okay, so I'm going to think about that for just a second, and then you can pipe up, or I'll see if I can recall what people tend to say about their greatest investing desires. Some people who are nearing retirement, they say, I want to get myself in the right spot so I can retire and have a good life during retirement. And so that's my investing desire to take care of that. Some people say, well, I'd like to retire early. So I'd like to really, gun this investing. I'd like to really be successful at this investing with the hope that I can retire. Now, another angle on this is that a lot of people approach this from a different angle. They're just worried about losing their shirt at some point. And so the worry is, how can I navigate this and not take a big loss and not experience that kind of disappointment with this. And some people say, you know what, I can tell you right now what I'd like to have guaranteed returns. I'd like to have about 20% a year. And then I'd like for my advisor, or whoever is helping me, to make sure I don't lose money, because it makes me nervous when the market crashes. So if they're really good, they would know when the market's going to crash, and so they would get me out of the market, and I would have cash. Then at exactly the right time, I'd go back in and continue to make my 20% a year. But I'm never going to have those downsides. So that's kind of the perfect investment advisor I'm looking for. That's my big desire. What do y'all think? That's good? Is that good, Ronnie? That's the perfect answer probably for that. So what we got a war for your mind on Wall Street. They can use these fears and our desires for what? Just to help you? I mean, that's the picture they want to give, that they're this great marketplace and they have all these people who are experts and they can just help you do whatever you need to do to realize your greatest dreams and to avoid whatever pitfalls you think is ahead. And because this plays right at our heart of our life savings, they've got our attention. Okay, so we're going to talk about 3 types of Wall Street bullies who are not aspects that are not working in your best interest. And the first one's the con men. So we got Reed Slatkin here. He did a $600 million Ponzi scheme. We got Thomas Petters. He managed a $3.65 billion Ponzi scheme. And then Alan Stanford did an $8 billion Ponzi scheme. And that's the only one that I have had anybody that I knew was hurt by that. And so one of my colleagues, his father-in-law lived in Dallas, and he was an executive with Ready Ice, which apparently is a humongous company. And he had his 401k with Stanford, and he was just about to retire when he got a letter from the receiver saying that that the Stanford's assets were all being seized and the FBI was looking at it and all that stuff. So that's the only one I know about. Of course, people that have been scammed a lot of times don't want to mention that it's really a painful thing. You don't want to bring up that you got scammed. Now, of course, the father of all Ponzi schemes is Bernie Madoff. He managed a $65 billion Ponzi scheme. And you guys know what a Ponzi scheme is. That's where the investors puts his money with Madoff. Madoff phonies up a statement for all of his clients showing this wonderful returns. Madoff makes big distributions. I don't know, it was like 8 or 10% a year, and the portfolios would rise by 18% a year. And so he had this cult following of people. And so this wasn't something that only lasted a little while. It lasted for years and years. Let me see. I may need to switch. No. So anyway, Madoff's scheme lasted from the early 90s until 2008. So it was very sophisticated over a very long period of time. Now, one of the things that we always do is see you and I, we are really smart and we've been around, weren't born yesterday, and we would not fall for these things. We're not like some guy in Nebraska out there that's plowing up the cornfield. We don't not going to get ourselves into some weird situation like that with Madoff. So let's look at the Madoff victims. So here's Uma Thurman. She's an actress, and Arpad Hussain. He was a hedge fund manager, for crying out loud, and he lost 270 million. And then this guy is Walter Noel, and he ran a hedge fund. He was a Harvard Law School grad, and he lost 7.3 billion. And this poor guy, Rene Villachet, was an investment advisor, and he lost $1.4 billion of his clients' money. And he was so distraught by it, he killed himself. Which at one level might seem like an appropriate thing, but it also talks to the severe distress that the victims felt. And of course, these were huge guys, but there were a lot of other people that got hurt. Now, notice that where the people were that fell for Madoff. First thing to notice is nobody in Nebraska fell for Madoff. That the Madoff victims were in, the Northeast, New York, Connecticut, all that. They were in Miami and Florida, and they were in Denver and Aspen, and they were in Los Angeles and San Francisco. They were in the big cities. So these were sophisticated people, and they got taken. They didn't ask the right questions. Okay. So I don't know if you want to add anything to that or not. Last week, or it seems like last week, a couple of weeks ago, I did a presentation on verify, verify, verify. It had a lot more information about the Ponzi schemes. Okay, the next thing we want to talk about, and I hope none of you guys get involved with that. Obviously, it just ruins people's lives if they get mixed up with one of these people, because the typical Ponzi scheme gives tremendous returns, and the account statements show these glorious results, and so people tend to put more and more of their money in it, and then when they go bust, those people that relied on them are ruined in many cases. So it's just a terrible situation. Now, the next one we're going to talk about are prognosticators. And this is everywhere on Wall Street. This is what Wall Street does. Okay. And it's so common, we just let it go by in passing. But let's think about it a little bit harder and what we can learn from this. So here's an example of this. So we have Forbes magazine on July 19th, 1993. And you guys are old enough to remember that this was the start of the Clinton years. And Clinton was elected in 1992. And his first term, they were doing all kinds of stuff that had disturbed a lot of the they launched a bunch of programs that a lot of people were not happy about. And so here's Forbes, and we got this guy in a bear suit, and it says bearish on America. And it says sell US stocks, buy European and Asian, says Morgan Stanley's Barton Biggs. Now, Barton Biggs is still a big deal. So he's at Morgan Stanley, and he's on the front of Forbes, and he's the head of their research department or something. And he says, sell US stocks. He says, I want to get as far away from Bill and Hillary as possible. The president is negative for the US stock market. Is a negative for the US stock market. Okay. So if you were looking around at getting some general guidance in July 1993, you might have read that Forbes article and said, well, this guy is an expert, man. He's this big deal at Morgan Stanley. Maybe I need to do something. Maybe I need to stay away from the U.S. market. I'm not too keen on internationals, maybe you said to yourself, but this just worries me. I'm not getting in that market, you know. And when you got this prognostication, does he say, listen, you know, in 6 months I'm going to update this, or in a year I'm going to update this. Stay tuned. No, you don't have any idea what he's talking about, what the time frame is. Okay, here's another one. So let's imagine you're wandering around in 1999. And if you were wandering around 1999 and you were invested in the stock market, you were a happy camper because this was the top of the tech bubble. Do you guys remember the tech bubble? Do you remember Global Crossing and WorldCom and Lucent and all those other stocks? Do you remember this? And this is when the guy mowing your lawn was giving you stock tips and talking about his portfolio of tech stocks. So if you went to the library and you said, or to the bookstore, you went down to Barnes and Noble or whenever, you know, there used to be bookstores. Now they're getting kind of rare. Anyway, you go to the bookstore and you say, well, you know, I'm more intellectual. I need to look ahead to the future and kind of get my bearings as we're going, as the you know, the millennium starts. I'm a long-term investor. I want to get the picture here. So you pick up Harry S. Dent's book, and it's the Roaring 2000. You kind of like that. It's, you know, it's upbeat, happy stuff. And it says, building the wealth and lifestyles you desire in the greatest boom in history. Whoa. Well, I've been doing pretty good right now. This is really going to be good. And, you know, I may retire early. I'm not sure. I may just, you know, I could just probably just keep investing, and I'm not sure I even need to work anymore the way the things are going. And here's this sounds like it's just going to continue. This is just wonderful. So how did all this turn out? Well, if you followed Barton Biggs and you stayed with his recommendation through the Clinton years, okay, so this is 93 to 99, right? U.S. large, that's essentially the S&P 500. Went up 22.5% per year, 273% total return. It was one of the big runs in the S&P. So do you think Barton Biggs apologized to everybody, or that Forbes brought out a cover and said, oh, we're sorry we came up with that one? Oh, no, man. This is just... And then how about the Roaring 2000s? If you lived through the 2000s, you knew the stock market, the U.S. stocks did not do well. And the S&P 500, just as a point of reference, for 10 years, 2000 through 2009, lost 9%. This was, people called it the dead decade. How did your life savings do if you were invested in your normal U.S. large stocks during that period? Terrible. Okay. So this is an example of now prognostication goes on all the time. We just accept it. And it's like, okay, well, they're, you know, sometimes they're right, sometimes they're wrong. Well, just think about that for a second. There's no firm ground. If the prognostications you get are unreliable, and yet most people invest in the stock market based on this is what we call, this is how we get data to support whatever we're going to do. You know, if you're pessimistic, then you read something that's pessimistic and you do pessimistic. If you're optimistic, you read something optimistic and you do something optimistic. It's playing off. It's like some sort of circuit that's self-fulfilling, but it has no future accuracy. I just think about how foolish this is as a way to think about handling your life savings. Okay, if that wasn't bad enough, so these prognosticators giving you the big picture, let's talk about the people who are going to give you the spot-on information you need in any given time. Right, and this is always going on. It's 24/7 on TV. It's what's all the financial magazines. It's the business pages of the Wall Street Journal. This is the great game: prognostication and gurus. So here in 2003, we got these gurus. It says Financial Advisor magazine, against all odds, Arnold Vandenberg has delighted clients by beating the market over a 29-year period. Now, our reaction is very simple and very wrong. We say, these guys understand what they're doing. These are the people I need to invest in. That's so anytime we have a famous guru, he draws this enormous amount of money. And it works off the fact that we think that if the pattern existed in the previous years, that it will go forward in the future. And many things, and the reason we think this is because many things in life are like that. But the stock market isn't. But we're fooled by it. So this is really one of the ways we are tricked. Now, this slide says how monkeys throwing darts over a 29-year period have beaten the market. So what are they talking about that? What are monkeys throwing darts, or people throwing darts for that matter, beating the market? What's that have to do with this Arnold Vandenberg? Well, here's one of the principles of investing. This is Nobel Prize winning stuff. This is something that if you read Seriously Investing, this is what you find out. Okay, so let me just read this paragraph on the side. It says, a blindfolded monkey throwing darts at a newspaper's financial pages could select a portfolio that would do just as well as one carefully selected by experts. So this is a paragraph from Burton Malkiel's A Random Walk Down Wall Street. Okay, Burton Malkiel is one of the big heavyweights of investing theory and of advice. And his book, this Random Walk Down Wall Street, has been published, I don't know how many different times it's been updated and issued for decades. So what does he mean by random? Here's the problem. The math is that from the time you buy a stock or start looking at it, you might think it was a great company and a great stock, or you might think it was a bad company and a bad stock and you should sell it. But mathematically, its movement from this point forward is random. 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 Okay? Now, we're going to talk in a minute about how this illusion is created of expertise. But this is part of how we're tricked and tricked over and over again. Okay, anyway, continuing a little bit with this whole idea. Remember, we're looking now at gurus who are going to give us exact information on what to do. And so here we got Fortune. And so this is August 14, 2000. And this is a great magazine cover. So it says the 2000 Guide, Retire Rich. And then on the right side, it says real strategies for real people, 10 stocks to last the decade. And of course, we've got the couple floating in the Caribbean, idyllic hideaways to call home after you make your fortune in the stock market, right? And so what the article said was, it said they've identified 4 sweeping trends that appear certain to transform the way we work and interact. And so they sought out the top stock pickers in the country to tell you what to do. Okay, what could be better than that? I don't have to do as much research because these are the top guys. I mean, this is Fortune magazine, for crying out loud. So how did these 10 stocks do that they said were going to last a decade? Over the next 27 months, minus 62%. So if you had $1 million, now you got what, 320? Thank you much. Next decade, minus 47. Had a million, now you got a half a million. Thank you very much. Okay, how about this? Here's another article, same time frame, July 24, 2000. This is Fortune, top picks from the smartest guys on Wall Street. And we got this guy, and he's got his jacket on. He's Fortune's all-star analyst. So these aren't just some run-of-the-mill analysts. These are the Fortune all-star guys. And it says, let them make you rich. Now, how do you feel when with a title like that, and the market's going great, and you just want to keep on going, man? This is great stuff. So here's one of the experts says, Amdocs, July 5th, 2000, $73. The expert said it can hit 100 from its current perch. So how'd that go? Well, it didn't end up perching higher. It perched to $51, and then it perched to $25, and then it perched to $27. Thank you very much. You lost 2/3 of your money. Or how about CMGI? Everybody was in CMGI back in those days. And in July 5th, it was one of the really up there. It was $443 a share. And what did the experts say? They weren't daunted by this high price. No, a screaming buy. Well, on July 5th, 2001, it was $26. 2003 was $15. And July 5th, 2005, it was $19. So you'd be screaming, all right. Or how about Global Crossing? Global Crossing, it had all those ads with the stuff circling the globe. They were going to completely redo broadband worldwide. July 5th, 2000, $26. Could be $70. All right, we're going to triple our money. This sounds so good to me. Could be zero. Lost everything. And remember your friends and relatives who were in Enron in this period and lost everything? WorldCom, July 5th, 2000, $45. Dirt cheap. Well, it was in the dirt, all right. In 2002, it was zero. So the point is, when people are telling you that some stock is going to go up or go down, they're not always wrong, but they're not always right. And they can be spectacularly wrong. And the whole point for you and your life savings is this is completely unreliable. There is no math there. There's nothing to go on. There's no firm ground here. And yet everybody's all into this great game of betting on stocks. And that's what it is. It's betting. It's like buying a lottery ticket. Okay. So this is not the way we want to play the game. You're being tricked into this. I mean, they're playing off all of our emotions. It's the great game. It's the understanding of the way thing works. And it's just misleads people. So, they've got all these books for dummies, stock investing for dummies. And of course, one of the ideas of these dummies books is they're going to take some subject and they're going to give you information about it so you can do the thing yourself, right? And part of the deal is to make it seem simple and approachable. And of course, Wall Street's all into that. All these apps and all the websites look like gambling sites for all the financial industry. It's just all this wonderful information available so you can make your fortune on Wall Street. Now, if you ran across this book, Brain Surgery for Dummies, now you would back up a little bit because it's one thing to know you could buy a scalpel, but you would hesitate to cut into someone. You just sense it isn't feasible. But we don't sense that with mutual funds. We think, well, I know what a mutual fund is, therefore I can be an investor. Not so much. So how do they perpetuate the deception that they can predict the future? Just everywhere, every day. People are telling you they can tell you what's going to happen, and that therefore you should, buy or sell. How do they create the illusion? Okay. So one of the points I'm trying to make to you today is that there's this whole ecosystem of how Wall Street works, and we just accept it. It's like, okay, that's how it works. It fits with other things we know about, and so and that's what you always hear, and it makes sense. And so we're inside of their ecosystem, and their ecosystem is not good for you, for your peace of mind, or for your life savings. So how do they create this illusion? So do you guys know who this is? This is the famous magician. He was in Las Vegas all the time, David Copperfield. And, they don't like to be called magicians. They like to be called illusionists because, they didn't really saw that lady in half. They didn't really, make that rabbit disappear. It was an illusion. They created an illusion for you. And you say, well, is Wall Street really trying to create an illusion for me? I'm not that paranoid. Are they really evil? Well, as it works out, it turns out for many people to be evil in the results we get. So how do they create the illusion? So one of the most common ones is the law of large numbers. Okay. How do they create the illusion? The law of large numbers. And they use this to create the illusion that someone has a great record and therefore you can rely on what they say. Okay. So we can't really do this very well here because there aren't enough of us. So you got to listen to what I'm saying. Okay, let's talk about coin flipping, because what we want to do is talk about random, about the nature of random numbers. And so everybody in this group knows that, you got a coin, it's got two sides. If you flip it, it's a 50-50 chance that it's going to land on heads, or 50-50 chance it's going to land on its other side, tails, right? That's intuitively obvious. Okay. And that's what we think we mean by random, that things just they just go back and forth because of this 50-50 chance. But actually, if you did repeated coin flips, a certain percentage of people flipping the coin will get heads over and over and over and over. Okay. So there's a 25% chance that if you flip the coin twice, you could get heads twice. So 25% that you would get heads twice. And if you flip it a third time, there's a 12.5% chance that would happen, that you would do it 3 times in a row. Okay. Now, if we had a big room full of people, like Mattson does this for his American Dream experience, which I hope some of you guys will go to in the future, the American Dream experience. And so where he's got, 200, 300 people in a room, and he gives everybody a quarter, and he goes through this whole drill. And so what you do is you stand up and you flip the coin, and if you get heads, you remain standing, and if you get tails, you sit down. Okay. And then the people that are still standing up, they flip the coin again. And so if you have enough people in the room, there are going to be people standing after multiple flips. The odds aren't high, but they are there. And so Mattson said in one case, he had people where one guy flipped heads 10 times, 11, or I think it was 11 times. Right. So you say, well, what has this got to do with Wall Street? Right? What's this got to do with Wall Street? Well, if if Wall Street was going to play with large numbers in order to create this effect, they would have to have a jillion, mutual funds or something that would, in order to simulate this effect. Now, if they actually, let's just take Fidelity, if they actually knew what they were doing, if someone actually knew what they were doing, that you wouldn't, then it wouldn't be random, and they would just be able to do exceptionally well year after year after year after year. So how many mutual funds does Fidelity have? And without picking on Fidelity, this is, in any mutual fund company or any of the big funds, they have of these funds. 1,281 funds. Now, do you see what's going on here? That what happens is, and some of these, they're like seed money. They create these, and the people that are managing it are, they're stock jockeys. They're guys that have devoted their life, and if they're successful in creating one of these streaks, they're going to be rich beyond their wildest imagination. They have every incentive to try to beat the market and to beat the other mutual funds. But what Fidelity is able to do then is they take the manager that has a good streak going, and then he's the guy, his fund is the one that's advertised. And so he's made, 25% a year for the last 5 years, or he's made 30% for the last 3 years, or last year he got 45%, or whatever it is. And he goes on all the shows and talks about his techniques and what he's planning to do next. And they advertise him. And on Morningstar, he comes up as, a 5-star rated fund on Morningstar. And the money just flows in. And the funds that don't do well, they just close them down and merge. So they have this setup for creating this. Now, this wouldn't be quite as sinister if the funds that were identified as having done this great thing over the last period actually continue to do well in the future. But I say this always. Here's the facts. The Wall Street Journal did a expose on the Morningstar 5-star funds in the fall of 2017, not back in the business page, on the front page of the Wall Street Journal. It's an expose. And it said that the chance that a 5-star Morningstar rated fund would be a 5-star fund, or be in the top group, in other words, over the next 5 years, it was just as likely to be in the bottom as in the top. In other words, going forward, its return was random. Okay, so this is how you and I have been tricked by actively managed mutual funds, because since the market is random, these guys are picking stocks. The fact that they were lucky in prior years, if they had a good streak, they followed the streak, they were on the streak, they were on the hot thing, that gives you no assurance whatsoever about what it's going to do in the future. Totally useless. So just to accentuate this point, the total number of mutual funds in the United States, there's 25,691. The total number of stocks in the United States to invest in, 21,000. So if Fidelity really had the manager who knew, how many funds would they have? One. And if that guy knew which stock was going to be best next year and the year after and the year after, how many stocks would be in his mutual fund? One. Do you see you have been had? And I'm not blaming you guys. The Morningstar thing, I did that stuff for years. Anybody got any comments on this? You should just feel like you've been violated when This is just ridiculous. Okay, now that's the result. It's ridiculous. And you and I have been fooled by this nonsense. And you think bully's too strong a word. You think um, that this idea of repetitive or intentional harm. You think there's not people at Fidelity that know the principles of investing, that know the markets are random? You think they don't know this up there somewhere? Now, this also tends, a lot of people say, especially after the market crashes, they say, I am never getting near the stock market again. I'm never going to do that. That was terrible. We lost all kinds of money. I never want to get near that thing. I'm going to put my money in a CD or annuity. The annuity salesmen come out of the woodwork when the market's crashing or when it's choppy. And I'm not here to sell you any annuities. They have very limited use in this world, and mostly they're misused. And I'm also not suggesting that you put all your money in CDs, because CDs don't pay enough interest. You're just going to lose money over time. So this is not an option. So what is one of the greatest, if not the greatest, wealth creation tools on the planet? It's stocks. It's stocks. So how in the heck are you and I and your family supposed to get the benefit of this? So look at this. These are asset classes. These are different segments of the stock market. So the first one is on top is because everybody's heard of it. Everybody's heard of the S&P 500. It's used as a measure of how markets are doing every day. And since many people are invested in S&P 500 index funds, you're familiar with the idea. It holds the 500 largest corporations in America, and every 6 months, if one of them crashes, then they bring up the one that's now part of the 500 largest. So it's stable over time. It's the 500 largest corporations in America by market capitalization. And they have data on it going back to 1927 when the SEC got started good and began to take in the financial statements and other data about these companies. And what is the return over this huge period from 1927 to 2020? It's 93 or 94 years there, 10.27% a year on average. Now, keep in mind, it goes up and down, but the average annual return, 10.27%. Notice, no stock picking. You just hold it. No market timing. If you get in and out, you won't get the return. Because nobody knows exactly when it's going to go back, when it's going to go down, or when it's going to go up. And if you miss the rises, you won't get this return. You can't be out of the market much, unless you're clairvoyant, in which case you don't need to be talking to me. But most of us are not clairvoyant. So this is how you play it. You buy and hold an asset class. Now, there's a lot of asset classes. I should say there are a number of asset classes that have been studied over a long period of time and that have desirable, listen to me, desirable expected returns and desirable standard deviations. That's how much up and down they go. Okay, so these are examples of those. The U.S. large value, 11.8%, same 1927 to the current. U.S. microcap, 12.38% a year. U.S. small cap value, 14.26%. International large, 9.31% since 1970. International small, 14% a year. No stock picking, market timing, or track record investing required. Okay. Now, there's a lot more to be said about that in my presentation called the Separating the Myths of Investing the myths of investing from the truth. We talk more about the academic principles and how these arose. So this presentation is designed to go with that one. So what are our assertions? There are Wall Street bullies who can profit from destroying your American dream. So Wall Street's goal is to get you to buy stuff. And so because this plays against our greatest fears and our greatest hopes, it's easy to excite us to buy when the markets are going up and to sell when we're scared. And all of that's good for Wall Street. Okay. It's not good for you. In order to the antidote to this is to master these empirically tested academic investing research so that you will be insulated against Wall Street stratagems, and you'll be able to put yourself in a position to actually have the best opportunity of success with your life savings. So you and I have real dreams, and we need real returns. So one of the things that I'm sure all of you've heard of, and that is that if you're approaching retirement and you say, well, how much money can I take out of my investments every year and have them last? And so the most often stated rule of thumb is you can take 4% of the value of your investment assets each year if they're properly invested. And you could have the expectation that over time, not every year, but over time, the value of your life savings will rise at least enough to offset inflation. And that means your 4% would get a little bit bigger over time, and that helps to offset inflation. And when you pass away, or you and your spouse pass away, there will be money left to go to your descendants. So this is the idea of the 4%. Some people do 3%, some people talk about 5%, but it's somewhere in there that you could have a sustainable rate of withdrawal and have your life savings continue. So one of the paradoxes of this investing problem is the single mistake. So just think about this. And many things in life, let's say you were dieting for a long time. And you'd been successful dieting, you'd been very disciplined, and you had lost some weight. But one day you were going by you were at this restaurant, and you had ordered your food, and you noticed there was a sign, and it said, "We have Bluebell ice cream." And you've been laying off of desserts for a long, long time, and it was kind of a special day, and you saw that Bluebell ice cream sign, and and then when the waitress came by, she said, "You know what? You could get hot apple pie with a big scoop of Bluebell." Now, you're going to have that and you feel bad about it because you're breaking your resolve to not take desserts. But it's not the end of the world. The next day, you can just go back to your plan, right? You can stop. It's not going to be the end of the world. But in investing, a single mistake can be terrible for you, for your mental feelings, and for your future. So examples of that are, remember I was telling you about the guy that had his 401k was with Sanford, and he just got ruined on that. During the 2008 crash, I know that there were a number of my clients that they rode that market down as far as they could go, as far as they could stand. They sold and took a big haircut. They swore off of the stock market. They switched over to CDs or annuities, and some of them never got back in. In other words, their life savings, their prospects for retirement had taken a permanent haircut through that 2008, their response to that 2008 crash. So investing mistakes can be costly, and they're very hard on our psyche, and they're hard to recover from. Sometimes we just can't recover because after that we make terrible mistakes. Okay, so this is a Matson results to give you a different idea about this. So this goes from 1992, and these are actual results of if clients invested with Matson using these academic principles on how they would have done. So let me help you with this chart. We all love charts, right? So it starts in December 92 and it goes to December 2020. And the bottom line is this blue flat line is if you invested 100,000, the question is, how much would you need in 2020 to buy the same amount? And the answer is you'd need $184,000 to buy what 100,000 would have bought about 30 years before. Okay. So then, if we imagine that an investor invested with Matson, and I should probably say these are actually how an investor would do who invested with Matson in 1992. And these are net of expenses. Okay, so the first one we have is an income and growth portfolio, and it is 75% fixed income. It's only 25% in equities. And so this is the second line up. And notice it's relatively flat. In other words, it's got relatively low volatility. It's a conservative portfolio. You wouldn't have to worry that you were going to watch the value of your assets decline sharply during a 2008 or a tech crash because it's got so much fixed income in it. So that client would have gotten 273,000. So the 100,000 turns into 273. Or if that was $1 million, it would have turned into 2.7 million over those years. The next portfolio is the balanced, and so this is 50% fixed income and 50% equities. And so it has, notice it's more up and down, but less than a portfolio with more equities. And the return for that was 100,000 would have turned into 421,000 net of all the fees. So all the fees are out of it. So the investor would have 421,000. The next one up is long-term growth portfolio. And so keep in mind, these portfolios use these asset classes. This is a buy and hold strategy. And what you want to do is create a structured portfolio that includes a number of different asset classes, because this is the Nobel Prize principle of how to organize one of these portfolios. And that this one has 75% in stock equities and 25% fixed income. And it's a lot bumpier ride, but the client was rewarded for that because the 100,000 became 571,000, or if that was $1 million, it became 5.7 million over that period. And finally, the top one is a 95% equities and 5% fixed income, and that's the 696,000 net of fees. And so that client, if they'd invested $1 million, would have 6.9 million at the end of that period. So this is what clients need, and by using these academic principles, you can actually bring math to bear on what you have, your expectations about the future. And nobody knows what the future is going to bring, but based on the historical results, the movement of these asset classes is predictable. Whereas the stock pickers portfolio is not predictable. The asset classes are, and there's only a handful of them, those have desirable expected returns over time. And mutual funds or individual stock picks do not have any math. There's no math going forward. Now, the next question is, talk about the journey within. So we got these Wall Street bullies. We need to master these empirically tested academic investing research, and our dreams are worth fighting for. So what's the problem? What's the problem? We just learn this and just do it, and then we'd all be live happily ever after, right? The problem is our heads. Okay, that's the problem. And if we're going to be successful, we got to get control of our head. And of course, we all think we're very analytical. So we got the investor's brain, and we got this cognitive part, and that's all of us think that we're so rational. My wife might be emotional, but I'm not, right? And then we've got how we perceive stuff, and we got our instincts, and then we got our emotions. But no, we're just rational. Well, actually, if we're going to be rational, we got it. So the C is your cognitive. That's your rational side. And so our little equation says that if this is going to work, your smarts have got to be greater than your instincts, that's the I, plus your emotions, plus your perceptions, multiplied by the media, which exaggerates everything all the time, right? So the cognitive is what we know. So why do investors fail and people gain weight? So the first thing we got to go ahead and accept about ourselves is that even when we know something, that doesn't necessarily mean we do it. So the most obvious one to say is, if we need to lose weight, what do we have to do? We got to eat less, move more, right? But do we do that? Well, not necessarily. And so there are an awful lot of things in life like that. And this happens to be one that is definitely a move. Investing is, as much as we'd like to say how rational we are, a lot of what's going on is not so. It's not that way. What we know is overridden by how we behave and feel. And also by this misunderstanding that Wall Street's created for us. Okay, so let's give some examples of this. So here we're going to talk about our instincts. So if we feel pain, what do we do instinctively? We want to get away from it, right? We want to get away from it. And if we feel pleasure, we want to go to it. So our instincts say that if something hurts, you get away from it. And if something feels good, well, we want to do that. We want to move towards it. Now, you don't need too much insight to think, well, yeah, but notice this is misleading, okay? Because if we have cancer and we need, we have to go through chemo is painful, but we need to do that, right? And so we have to go towards the pain, even though our instincts say, no, 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 no. And some things are pleasant, like this food, the bluebell or whatever, but we need to push ourselves away from the table in that case. So our instincts mislead us. So do you think that might be true in investing? You bet. So let's look at this. So remember 2008 was not a happy time if you were an investor in this world. All the news was bad all the time. And so you open up your statement, okay, and your long-term government bonds went up 25.87%. Holy cow. All this bad news, and my bonds are, thank goodness for my bonds. And you look over there at these small stocks that you bought, and they're down 40%. God. Oh. So what do your instincts say to do? Well, they say, I want some more of those government bonds. And I need to sell these stocks and get some more government bonds. So how does this turn out? In 2009, those long-term bonds went down by 15% after you loaded up on them. And at the end of 2009, the U.S. small had gone up 50%. And not only that, you had violated all the rules. You had remember the big general rule is invest in equities, diversify, and rebalance. Okay, so what did you just do? You reduced your diversification by selling your stocks and loading up on bonds. You sold the stocks while they were down, and you bought the bonds while they were up. This is crazy. A crazy mistake. Now, many people did this in 2000, this kind of thing in 2008. The other thing that was going on in their mind is they thought that stocks that they had would never return, would never go back up. They had no confidence that what they were in would ever go back up. And so they lost all hope. And so they just bail out, get completely out, get away from the stock market. That was part of the problem in 2002 and 2008. Okay, how the emotions, how we feel. All righty, I'm gonna stop this here, and I got to change the setup so you can listen to this. Just 1 second.
Maria, it's never coming back. Living standards will never be the same. You cannot have an $8 trillion negative wealth effect from housing. You can't have a $10 trillion hit on capital markets. You can't have a bunch of insane government programs and bailouts and everything else. Nothing makes sense. The consumer knows it. It's indefinite.
So what was the emotion there? It was fear, right? Fear. And of course, right now it sounds crazy. But when did this guy say this? He was this talk, this his TV appearance was in February 2009. And he was saying it's the end of the world. This was the exact bottom of the stock market. So this is when you should have been buying. But keep in mind, in 2008 and in 2009, at this point, all the news was bad. Even though the market was starting back up, all the news was still bad. Everybody was gloom and doom. The economy was coming apart. There's no hope. So it sounds crazy now. It didn't sound crazy then. It just fit the mood.
Oh, I hear some cheering. We're getting there. Turn that up. There it is.
It's gonna go through.
Oh, baby.
Mama.
Now, where were we a year ago this time?
Was that premature applause from the floor? I believe that was probably premature applause from the floor.
Up.
1/2 point away.
40 cents.
40 cents is all they need.
So
this is how close we came to Dow 3000 and didn't make it.
So why don't you buy 100,000 IBM?
Quick, Joe, put in an order for 100,000.
Get this through.
There it is.
Hey!
There it is. 9,000. Reached on the Dow Jones Industrial Average 8 minutes and 45 seconds into the trading day on April 3rd. First time ever over 9,000. And once again, a millennium mark falls on CNBC's scorecards.
I'm going to stop that share for a second so I can get the normal picture back here in just a second.
Oh, I hear some cheering.
Okay, so on that last video, they ended up singing because the market hit 9,000. So what was the emotion then? joy, happiness. And what do you do when you have joy and happiness in the stock market? Well, you feel like you need to buy some more, right? In 2009, when that other guy was all fear, well, you had to get out. You had to buy an annuity. You had to get out of the market. You had to sell. And remember, fundamentally, Wall Street is set up to get you to buy and sell. That's their business model. All good. Playing on these emotions that all of us have. But just understand that when that guy was preaching doom and gloom in 2009, that's when Warren Buffett was buying like crazy because everything was on sale, fire sale price. And when every time the market hits a new high and more and more people pour in, that's the time to be cautious, to say the least, if not to plain. Anyway, the main point is we shouldn't be buying and selling into the market. The way to win is to buy and hold because nobody knows what markets movements are from day to day going forward. Okay, the next one we're going to talk about is perceptions. And this has a lot of different angles on it. You know, if you're like me, I bet you are. Sometimes I think I am the only sane person. Do you guys feel like that? I'm like, does anybody understand? I mean, am I like the only one that can really see this thing clearly? Now, in other moments, we realize that probably not exactly right. But even our eyes trick us all the time and our ability to understand things. So here's one example. So you look at these two tables. So which one is the longest? Well, the one on the left is the longest. Anybody can see that. So then we measure them. And I'll be darned. This thing. And even after we know that, it still doesn't look right. Our brain is somehow hardwired to misconstrue this. Thanks a lot, brain.
The monkey business illusion. Count how many times the players wearing white pass the ball.
Mary, can you hear that? Okay.
The correct answer is 16 passes. Did you spot the gorilla? For people who haven't seen or heard about a video like this before, about half miss the gorilla. If you knew about the gorilla, you probably saw it, but did you notice the curtain changing color or the player on the black team leaving the game? Let's rewind and watch it again. Here comes the gorilla, and there goes a player, and the curtain is changing from red to gold. When you're looking for a gorilla, you often miss other unexpected events. And that's the monkey business illusion. Learn more about this illusion and the original gorilla experiment at theinvisiblegorilla.com.
Okay, so the first time I watched that, I was so intent on trying to count and trying to make sure I had the accurate count. And then I was real anxious to hear what the right number was. And I think I got like 17 or something. I didn't even count it right. The whole business about gorillas and curtains, it never even crossed my mind. I am so simple-minded that they said count how many, and that's the only thing I looked at all. So I don't know, maybe that's just the way I am. But at any rate, what I want you to, this isn't, what we're talking about is not about monkey business, obviously. Think about this. We make decisions to invest especially if historically we've been stock pickers, and I was a stock picker for decades, so I, I had a hard time when I found out that this didn't make any sense. It was like this terrible cognitive dissonance. You mean all this stuff I've been doing all these years doesn't make any sense? Oh, like a headache. And so, if you're not feeling some cognitive dissonance, I haven't really been successful this morning because I certainly had it at the time. But just thinking about this perception problem, you realize that in the capital markets, there are millions of players. You got like hundreds of millions of shares of stock in some cases that are outstanding, and you got hundreds of thousands or millions of shareholders. And then all these big companies have competitors and all kinds of other things. And yet we make a decision to buy a stock because our buddy that we were playing golf with said he made a lot of money in this stock and we should take a look at it. Or the stockbroker is trying to sell an IPO and he tells us this really an interesting story about how this new company is going to come on and they've got a new insight how to do something or other, and it's just going to take the world by storm. And that's it. We're all in. Well, this isn't investing. It's gambling and speculating with your money. You're buying a lottery ticket. And even if it's a great company, and there are great companies, you still don't have enough information to really perceive what's going to happen. Furthermore, the science says the movement of that stock price going forward is what? Random. Now, once you get that in your head, you realize there's not much point in owning individual stocks. Now, the problem for a lot of people that I'm talking to is they have a managed stock portfolio, and they picked a lot of those stocks, and then Morgan Stanley or Merrill Lynch, they're experts that picked a lot of stocks, and we've had those stocks and we have gains in those stocks, and it's like I'm attached to this whole process. The thing you got to know is there isn't any math on this thing going forward. There's not any real math. Now, when we analyze people's portfolio, we convert their what they hold into asset classes. But that gives them all kind of credit for stuff that isn't really there. Their real portfolios are riskier than the asset classes because they're not as they don't hold as many stocks and they're not as accurately on the asset class. So my point is, we have this resistance because we hold this portfolio and it's done pretty well. But the thing to know is there's no math going forward. Okay. If you're going to get any math working for you, if you're going to get the cognitive part working for you, then you got to change the way you operate. And this is such a valuable insight. Once you get it, you got to show your kids and family that they need to do this as well. Okay. Now, there's never any end to these prognostications and forecasts. So here's August 1, 2012. Are U.S. equities destined for a fiscal cliff? So even though the stock market had been up in 2012, it took another dip, and lots of people got scared and run off. And at any given time, there's always stuff. So one of the other problems that people have with changing their investing or deciding to invest is they can't decide when the right time will be, because things are always happening. There's always this uncertainty. And they think, if I just wait long enough, then it's going to smooth out, and I'll know where to put it. It's not going to smooth out. It's illusion. And what you need to do is you need to decide on an intelligent way to invest, and then you need to get switched over. So what's the biggest problem? The biggest problem is our head and our emotions and our attachments and our perceptions. And what you and I really want to do is we want to use our best intelligence, our cognitive part, to give us the best chance of success with our life savings. So bullies are out there who can profit from our failure. Your instincts point you in the wrong direction. Emotions push and pull us irrationally. And most people don't have a good comprehension of the empirically tested academic investing research needed to succeed. Other than that, it's easy. So if you want to become the hero of your own story, we gotta fight. We gotta overcome the inertia. For retirees and older people, we don't actually have to do something. We got to where we are. We thought it was okay, and I'm fairly comfortable with it. And if I get uncomfortable information, I don't really have to act on it. I can wait. Um, and there's something to be said for that. But in many cases, what it does is it keeps us from moving off and moving in a better direction, period. Okay. So what I'm hoping is that by making you aware that there is another way to approach this that is much more desirable in terms of giving you the best opportunity for success with your life savings. But notice one other thing about it. This is the way to get peace of mind for you, your spouse, your kids, because if we can figure out the best way to invest, and this best way to invest, we don't have to respond to the market. Remember, Wall Street wants you to respond. They want you to get all excited when they raise the taxes or the inflation rate or war or whatever, because everything that comes up is another buying opportunity. Well, you can enjoy the parade, but you don't have to participate. There's no point. It's not helpful to you to participate in this. This is a buy and hold strategy. You're doing the most intelligent thing. You don't have to pay attention to that. Okay. But what you do have to do is you've got to go through our training, and you've got to come to a realization, wait, there is a better way. I'm starting to get this. I'm starting to see this. Okay. So that's what we're trying to do for you today. And we want you to be the hero of your own story by moving in that direction. And so then this is all your American dream is taking care of you and your family and all the things you care about. And directly connected to that is your success with your life savings. And then you've got to be able to pass this on. You've got to be able to say something intelligent to your spouse and to your kids about it. I mean, if you got actually figured out an intelligent way to invest, and there's a million unintelligent ways to invest. Obviously, Wall Street's got them all out there for you to claim any way you want with their app, crypto or whatever. You want to pass that on. That's part of your legacy that you want to pass on. So this is a chance to refine and claim your American dream. So there's two types of investors. There's those that act and those that don't. And so, we can take this approach, and we've been fairly comfortable with what's happened. Maybe, we've been in a long bull market. So you can say, well, I've done all right. I don't really have to think about this so much. Or you can move out. Stand up to these bullies and punch them in the nose and reclaim the American dream. I'm hoping that after you hear what I just took you through today, you should be mad about this. I mean, this is just a trap for the unwary. That Wall Street's just a big trap for the unwary. It's like playing, on roulette. You put your money on the red or black. You don't lose every time, but in the long run, the house wins. Plus, you've got no security through this thing. Every time you do another thing, you may lose it all the chips you put on there. I mean, this is crazy. So if you're ready to fight, then you need to come along and continue your training with me and our discussions, and let us analyze your portfolio and give you all the information you need so you can see how to make this work for you. So now, one of the things that I want to end with is, when I look back on my investing life before I heard about the science of investing, it seems like to me I would have been way ahead if I had asked the right questions to start with, or insisted that certain things be answered. And now in hindsight, it doesn't seem like it would have been that hard to think about the right questions. But I don't know if you guys, have you ever, you bought a car and then something went wrong with it. And you said, golly, I should have had somebody check those brakes before I bought that car. Or I should have had somebody check that out mechanically. Or, you've been through that. Well, a lot of times our life would be improved by asking some good questions to start with. So, these are what we call the 20 must answer questions for your journey towards investing peace of mind. Okay, so the first one, and we haven't really talked about this much depth today, but and I should say as we start out, if you're keeping track here, if you're writing these down, don't give yourself a yes unless you've got it nailed. If you don't have it nailed down, you don't get a yes. Have you discovered your true purpose for money? That which is more important than the money itself. Now, obviously, your money is for some purpose, right? It's just piling it up. It doesn't make sense. It's for some purpose. And fundamentally, it's to take care of you, your spouse, and your kids, and the other things you care about. If you stay with us and if you go through all our training, we have a whole segment on thinking about your true purpose for money. And one of the reasons for doing this is that when you think about what your money's for, then you'll realize that the idea that you would speculate and gamble with it, playing Wall Street's game, makes no sense at all. So we want to win at this game. We want to have the best opportunity of winning, and we want some peace of mind about it. And all of this is to support the things we care about. So it's important to do it that way. Question 2, are you aware of all the mental biases and blind spots that you will likely face as an investor? Well, I touched on some of them today in the part we just finished here, but there's a lot of different biases that we all have that play into how we decide things and how we mess up deciding things for the most part. So I doubt you know all those. Question 3, are you invested in the market? Well, you either are or you aren't. If you're invested in the stock market, then that's a yes. If not, it's a no. If you're not in the market, you say, well, I got all this other stuff I'm doing. You've got to remember that if you have financial assets and you want to be a good steward of them, then investing in equities is inescapable. Right? Annuities and bonds don't have the same returns as equities do if you play your cards right. Question 4. Do you know the 3 warning signs that you may be speculating with your money versus prudently investing it? Now, in that separating myths video workshop that I give, we go into that in detail. But if you don't remember those now, it's a no. Question 5, do you have an academic understanding of how markets work? We've said they exist, and I talked about asset classes, but there's a lot more to it. We cover more of that in the separating myths workshop and in other workshops that I provide. Like next week, I'm doing the one on the vortex, and we'll talk about some of the technical aspects of creating a successful investment portfolio in that. So if you have an academic understanding, it's a yes, and if you don't, no. Have you defined your own investment philosophy? What are you trying to do? How much is going to be in equities? How much risk are you willing to take in a bad downturn? If you have, yes, and if not, no. Do you consistently and predictably achieve market returns? Now, if you're not familiar with the science of investing, you may not even know what I'm talking about. Okay. If you do know about it, well then, do you get them or not? If the answer is no, or you're not aware of, not familiar with this, then the answer to the question is no. When it comes to building your investment portfolio, do you know exactly what you're doing and why at all times? And what I mean by this is before I understood the science of investing, I would buy, I had stuff in my portfolio, and then I would decide to buy another stock or another bond or another mutual fund, and then I would try to think, wait a minute, how does that fit into what I'm doing? I mean, in other words, I was having a hard time figuring out how the different pieces fit together. And in my experience, in looking at investors' portfolios, Most people that I meet and talk with and look at, they just have a hodgepodge of investments. They don't know how much risk they have. It's not really clear how the different pieces fit together. So if you know what you're doing at all times, good. And if you don't, it's no. Question 9, do you have a system to academically measure portfolio volatility? Seems like that's important. That tells you, if we have another 2008, how much decline in your portfolio do you have to live through? And so we don't want clients to have portfolios that are so volatile that they can't sleep at night. Right? Part of our investment peace of mind is to be able to understand how this thing is going to work, and then to accept that and be able to sleep at night. Do you have an academic method for measuring your risk tolerance, and do you know what that number is? So if you do, you do. If you don't, you don't. Question 11, have you measured the quality and maturities of fixed income in your portfolio? Question 12, do you know where you fall on the Markowitz efficient frontier and how far under it you are? So this understanding of how to put together a portfolio is directly connected to Markowitz efficient portfolio. He won the Nobel Prize in 1990 for this idea, among others. He's considered the father of modern portfolio theory. When I look at clients, people's portfolios over the last few years, almost no one is anywhere near Markowitz's efficient frontier. Are you working with a financial coach versus a financial planner? Okay, there's either hundreds of thousands or millions of financial planners, annuity salesmen, whatever, out there. So why does the world need another one like me? And the short answer is, I'm not those. I am a financial coach. So what the hell is the difference between a financial planner and a financial coach? If you talk to your guy at Edward Jones or Merrill Lynch and you say, I'm interested in this, his reply is likely to be, well, hey, that's great. We have a whole setup for people that are interested in that. I can send you all this information. We can open up the accounts. We can give you things to invest in. In other words, they are enablers for you to enter into the wonders of Wall Street and follow all its paths, whether it's crypto or commodities or gold or silver, or picking the hot stocks or selling covered options, whatever it is. Okay, that is not what we're about. There are principles to investing, and so my job as a coach is to keep you and your family on the straight and narrow for this. And your family needs that because of the constant distraction that the media create. Do you have an algorithm and proven process for rebalancing your portfolio? Some people know about rebalancing. Most people don't know much about it or don't do it. It is a key part of having a successful investment setup. So if you know about that and you do it, great. If you don't, it's a no. Have you measured the total amount of commissions and costs in your portfolio? People always ask me, what are your fees? When I always turn around and say, what are you paying now? And it's surprising how little, in many cases, people don't have much insight into what they're actually paying. In the other workshop, Separating Myths, we talk about some of the hidden costs that are involved. Question 16, do you fully understand the implication and applications of diversification in your portfolio? Most people think diversification means owning a lot of stuff. Most financial advisors seem to think that diversification means you've got stocks and they're also going to sell you an annuity or some or gold or something else. It's just having a bunch of stuff. This is not what Markowitz meant by diversification. Thank you very much. If you understand what it really means, check yes, and if not, no. Do you have an investment policy statement that says this is how we're going to set this portfolio up? This is what it's going to hold, so forth. If you have that, great. So yes, and if no, no. Have you devised a clear-cut method for measuring the success or failure of your portfolio? This is just think, and I was guilty of it for years. And I would say, now what am I trying to do? Well, I'm trying to get rich. And, well, how are you doing on that? Well, not so good. I mean, what are you trying to accomplish? Well, I did okay last year. The market went up. Well, yeah, next year it may go down. Is that going to be okay? You know, what what is it? How do you do that? Well, if you got a good one, it's a yes. And if no, no. Question 19, can you identify the cultural messages and personal mindsets about money that destroy your investing peace of mind? Now, this is really connected to that finding your true purpose of money in many ways. If you stay with me, you're going to have a workshop on that subject. And for many families, it's very helpful because typically we grow up with the idea that that money's hard to get. You gotta save it. You don't want to spend it, and you're not going to talk about it. And so these kind of things don't actually create peace of mind about money. And question 20, this is the last one. This is one we'd really like to get a yes on. Are you ready to shift your personal experience of money investing from a scarcity mode to an abundance mode, where you can live your life rather than obsess about your assets? And there's some people that have so little assets as they enter retirement or whatever they're doing that really it's hard for them to have peace of mind, because some ordinary thing could happen and destroy what little savings they have. But for most of my clients, my estate planning clients, and the people that I talk to, that's not the case. We are blessed. And so wouldn't it be nice to have a good feeling about where we are, what we're doing, and where we're headed on this? And even if the world ends tomorrow, that's the best we can do anyway. Is use our head, have a good attitude about it, and if we know something, make sure our kids and spouse know as well. So that's kind of the. So I hope this was helpful today. I hope. Why don't I'm going to stop the share, and I don't, Ronnie or anybody